If you have home run, more people will come in. Whereas if your companies are all duds and shit, then nobody's going to come in. So most VC funds will eventually show that, hey, we have a good follow-on investor rate.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, Sierra founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
I'm going to continue with the LP deck review. So obviously, they show the investment team, and then they say, hey, we have some interns. So they talk about how we have a great founder experience. We treat them like family. Our thesis is that we invest in companies that show these 3 things: compounding modes, which includes proprietary data, network effects, and economies of scale. So these are the type of companies that we invest in, right? So we're raising 2 new funds, and then they show their fund performance. So again, they show like how much money they raised, how much of it was they called, which is they used. Then what's the multiple investment capitals, what's the returns, what's the TVPI, and what's the gross IRR, right? So the rate of return. And so what they're saying is we have 2 funds, so this is a little bit closer to a multi-stage fund, basically. But basically what they're saying is we will do a seed investment, right? Then we will do pro rata, there's the portfolio construction, a seed fund that does about a seed or Series A fund, about 50% of the capital will do the initial check, and then 50% of their fund size will go to do the pro rata for a smaller number of those portfolio companies. So for example, I give you an example was if you have 20 companies, a normal seed company will do, let's say you're doing 20 investments, you may choose to do, I'm just going to do a $200 million fund. $100 million goes into 20 companies at $5 million each, and then the $100 million, so half of that fund, goes to 5 companies at $20 million each. So we make 20 investments here, then we make 5 follow-on investments, the top 25% of the 20 that we think are winners. So this example of a seed fund that we have, or a Series A fund as well. That would also apply for generalist index funds like 40 startups, but the allocation of capital is about, just make it 50-50 on those 2 things. Then obviously this company basically saying we have an opportunity fund. So we want to do the round after that. So we're raising a separate vehicle to invest in the best companies that can do a Series B. So they did a C, then we pro rata for Series A, there's 1 vehicle, and then this opportunity fund will do follow on for that. It's a little bit technical, but I would say is your initial check normally is deployed across 2 years in general for most VCs. 2-year time period, the first 2 years. And then normally your pro rata will happen in year 2 to year 4, I would say, because your best companies 1 year afterwards will already raise a new round. So normally your pro rata will normally come in year 2. And then it may stretch up to year 5, I would say, around that time frame for you to find it, because you make the right investments. Around the time frame, year 4, year 5. And then the rest of the year is like silent because you're waiting for them to grow up further. Most capital, 50% of capital will probably be called by within the first 2 years, because you need to, in the classic strategy that we talked about, you deploy in the first 2 years, and then your follow-on investments. So normally the fund will try to do maximum, on average, 3 capital calls. The first capital call for year 0 to get started, and the capital call roughly around year 1.5, roughly. I'm just ballparking here to fund some pro rata investments and the last set of initial investments, and they'll probably do 1 last capital call for the last remaining quantum. And so some funds, the problem is that you do too many capital calls, you rack up a lot of legal fees, because every time you do a capital call, the lawyers are in, the accountants are in, you pay everybody and everyone's very happy. So you don't want to have too few capital calls, because if you're sitting on too much money, then your internal rate of return drops because your denominator of cash that you have in your company starts. Once you draw the cash, then you need to deploy that. Otherwise it's wasted because it could have been sitting in stock market or gold or something. So I think this is a good example where they show like these are our best breakout stars, if that makes sense. Robinhood is number 1, Flexport is number 2. Obviously, Policy Genius, I've heard that. The rest I haven't. We did this initial investment at this stage. When we first came in, this is how much we put in at that $3 million, for example. But now the current value is $50 million, for example. Current value of the round that was official, but the secondary price can be higher than the current round, because the current round could have been done last year or 2 years ago. They believe the secondary value is higher than the last proven valuation. But if you look at Southeast Asia today, most secondary price value is lower than the last round. So most VCs in Southeast Asia would not show this secondary price. And then of course here what they do is they say, hey, look at these great investors that follow on from us, that demonstrate signal. Stripe did our investment, blah, 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 Bullpen, etc. And so this will be a classic portfolio construction piece. So again, we're doing a total of $100 million fund size. We're doing 40 investments out of the total initial investment. The average check size will be about $1.25 million. And then we will have a reserve ratio of 1:1 for pro rata. So you do the math together. 40 times 1.25 equals to 50 mil. So that's half of 100. Then 50 mil is for the initial check. So a reserve ratio of 1:1 means that you have $50 million reserved to invest in the certain percent, a smaller percentage of these 40 companies. Portfolio construction is different because we're saying this is how we deploy your money. I'm not talking about how we spend your money. So we built large portfolio. We've created so much kind of top line numbers. Our companies have all raised a follow-on round, which is so much faster than the average C fund. And again, the best Series A funds lead out. Goes back to the signaling piece. They're proving that I'm correct. So now the time to double down. So argue about opportunity fund. We're saying we have so many VC funds in the past. Anyway, but I think what's quite interesting, the same power law curve internally. So within our portfolio, we look at the value of all these companies. Actually, 60 to 75% of their value comes from one company and then the rest. So they're saying like, hey, we have a power law. And because of that, we want to have an opportunity fund to continue investing in this number one company. So this is the same thing. So then they do the same math here, but it's a little bit different. So they explain the LP, right? So for opportunity fund, we have done 115 companies in total. And we want to invest in roughly, let's say, 10%, because they're still deploying this year, right? So we're roughly deploying about 10% of them. We're going to deploy $10 million each at the Series B stage. And then 25% reserve ratio. So we're reserving 25%. So 150 divided by that equals to about 50. And then, so 150 plus 50 equals to $200 million. So that's how they're calculating their portfolio construction. So for those who are doing seed funds or earlier stage funds, you need to prove over time that smart people followed you, right? Because if you have home run, more people will come in, right? Whereas if your companies are all duds and shit, then nobody's going to come in, right? So most VC funds will eventually show that, hey, we have a good follow-on investor rate. That will be a common market practice once the seed funds have done several rounds of history. But what we're saying, like, we have generated top desired returns because of experience. We are highly differentiated. And so because Tiyun is like, wow, every fund is highly differentiated. Now we invest along the best VC funds. We have repeatable process. Yeah. So they're saying macro environment, which not everyone's doing. Things are changing. Again, 60% of virtual returns come from top 6% of deals. But what they're saying is only the firms who can repeatedly get in access to those top 6% of deals can win. So we have to be differentiated. We are service first. And then so what they say is top tier returns through service. And they say, okay, what's defining service? Like founder health, right? Founders are mentally stressed, the mental health conditions. And so founders are 2 times more likely to suffer from depression, 10 times more likely to suffer from bipolar. So this is the stress. So you really kind of know what they're saying their value add is. So they're saying like, hey, we've built something that founders want, which is an Atlas program that provides comprehensive wellness and leadership programs. So choose us because of this support system. And this support system provides executive coaching, peer groups, therapy, sleep support, nutritionists, culture building. And therefore, that helps us get, and this is how they differentiate. Then our results speak for themselves. Again, best VC funds invest in our companies afterwards. This is our strong portfolio that you can see out here. And then I think this is more closely example to your case study slide. So they pulled out 2 examples. They say, hey, LFM Care is feminine hygiene care. They had a good exit. Lambda School, which is the income share agreements for coding engineering. So they try to explain why it's a good deal. Again, they do another 2 slides of case studies. I think here they do a better job, I think, to some extent, explaining who you are, but why you're so good at designing that. And then, of course, they're saying, like, these are sectors that we focus on. And then for them, they're saying, like, hey, we have no compromise, right? We do triple impact, and then we do top returns as well. We believe both of them happen. And then they do portfolio construction. So this is another way to show it, right? We do 20 investments, right? And we're doing $250,000 in the initial investment. And our target valuation around there is about 15 to 25 mil. So we own about 1 to 2%. And then we're going to deploy this in the first 2 to 3 years. And then the top 20% of our portfolio companies, in other words, 20 divided by 5 is 4. And the top 4 companies are the portfolio companies. We will do follow-on investments. And that's it.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.